You've probably already seen the title or thumbnail and guessed what we're about to explore. Let's dive in and see exactly how this works. You trust banks with your savings. But what if your money is working harder for the bank than it ever will for you? How banks profit from your savings. At first glance, a savings account seems safe. You deposit money, earn a little interest, and assume it just sits in the bank. The truth is very different. Banks use your savings to make money, lots of it. Your money rarely rests idle. It becomes part of a system designed to generate profit. Through fractional reserve banking, banks keep only a small portion of deposits on hand. The rest is lent to individuals, families, and businesses. Each loan earns interest, which is how banks make most of their profit. Meanwhile, the interest you earn as a saver is just a tiny fraction of what the bank gains. In simple terms, your money works harder for the bank than for you. Your deposit doesn't fund only one loan. Money moves, gets spent, deposited again, and loaned multiple times. This cycle allows banks to earn repeatedly from the same initial deposit. Legally and safely, the system is structured this way, but most savers remain unaware. While your account grows slowly, banks earn substantially behind the scenes. Banks also profit from fees, maintenance charges, overdrafts, or tiered interest plans. Even small, seemingly harmless fees add up, increasing their revenue. Understanding this system doesn't mean avoiding savings accounts, which remain secure. It means being aware of how your money is used and considering smarter choices, like accounts with higher interest or low fees, and alternative investments. Your money is part of a financial engine. Knowing this is the first step toward control, awareness, and smarter financial decisions. Why banks want your savings so badly. Banks don't just accept savings deposits out of courtesy. They actively compete for them. Sign-up bonuses, promotional interest rates, and easy mobile apps all exist for one reason. Banks need your money to operate efficiently. The more savings a bank holds, the more power it has inside the financial system. Savings accounts give banks something extremely valuable: cheap capital. When you deposit money, the bank can use it at a very low cost. Paying a saver 1 or 2% interest is far cheaper than borrowing money from other financial institutions or investors. This makes deposits one of the most reliable and inexpensive funding sources available to banks. With a large pool of savings, banks can issue more loans. Mortgages, auto loans, business financing, and credit cards all depend on available capital. Every new loan generates interest income, and that income grows steadily over time. The more deposits a bank has, the more confidently it can lend, knowing that everyday withdrawals are predictable and manageable. Savings also provide stability. Unlike short-term investments or market funding, deposits tend to stay in place for long periods. Most people don't withdraw their entire savings suddenly. This predictability allows banks to plan long-term lending strategies and manage risk more effectively. Stable deposits reduce uncertainty and increase profitability. Another reason banks value savings is trust. When customers deposit money, they are signaling confidence in the institution. This trust strengthens the bank's reputation, attracts more customers, and supports expansion. More customers mean more deposits, more loans, and more opportunities to earn through fees and financial products. The interest gap that creates bank profits. One of the most important reasons banks profit from savings lies in something called the interest gap. This gap is the difference between what banks pay savers and what they charge borrowers. While this concept sounds simple, it quietly drives the entire banking business. When you deposit money into a savings account, the interest you earn is usually low. In many cases, it barely keeps up with inflation. At the same time, banks lend that same money at much higher rates. Mortgages, personal loans, auto loans, and especially credit cards all carry significantly higher interest. The difference between these two rates is where banks generate consistent income. This system exists because banks take on responsibility and risk. They manage accounts, process transactions, evaluate borrowers, and comply with regulations. In exchange, they earn a margin. That margin, multiplied across millions of customers and loans, becomes substantial profit. Even small differences in interest rates can produce large returns when applied at scale. The interest gap also allows banks to operate sustainably. Loan interest covers operating costs, protects against defaults, and funds expansion. Without this gap, banks would struggle to maintain services or absorb financial shocks. For savers, this means the low interest paid on deposits is not a mistake. It is a structural feature of the system. What many people don't realize is how predictable this income stream is. As long as loans exist and deposits remain stable, banks earn steadily. Unlike investments tied to market swings, interest income is relatively reliable. This stability is one reason banks prioritize growing their deposit base, how your savings move through the system. When money is deposited into a bank, it doesn't remain fixed in one place. Instead, it begins moving through the financial system in controlled and regulated ways. This movement is essential to how modern banking functions and how institutions generate long-term profit. After deposits are received, banks allocate funds for lending and investment. Loans issued to borrowers are often spent on goods, services, or property. The recipients of that money then deposit it into their own bank accounts. This process allows the same initial funds to circulate through the economy multiple times, supporting continuous financial activity. Each time money re-enters the banking system, it strengthens overall liquidity. Banks use this liquidity to support new loans, cover operational needs, and maintain stability. While individual savers may see slow growth in their accounts, the system as a whole benefits from constant movement and reuse of capital. This circulation is not random. It is guided by regulations designed to reduce risk and maintain confidence. Banks must follow reserve requirements, liquidity ratios, and oversight rules to ensure that depositors can access their funds when needed. These safeguards are why the system remains reliable, even as money moves actively behind the scenes. From a profit perspective, circulation increases opportunity. Every loan issued generates interest. Every transaction supports financial services. Over time, these activities combine to create steady income streams for banks. The value of your savings, therefore, extends beyond your account balance. Fees, the quiet source of bank income. Interest isn't the only way banks earn from savings accounts. Another important, often overlooked source of income comes from fees. These charges may seem small or infrequent, but across millions of customers, they form a significant and reliable revenue stream. Savings accounts can include maintenance fees, minimum balance penalties, overdraft charges, and service costs. Even when accounts are well managed, certain conditions, such as inactivity or falling below a balance threshold, can trigger fees. Individually, these amounts may appear minor, but over time, they accumulate. From the bank's perspective, fees help cover operational expenses. Managing accounts, maintaining digital infrastructure, providing customer support, and ensuring regulatory compliance all require resources. Fees help offset these costs while supporting profitability. Fees also influence customer behavior. Minimum balance requirements encourage deposit stability, while overdraft fees discourage risky account usage. These mechanisms help banks manage liquidity and risk more effectively. Though often viewed negatively, they are structured to support predictable operations. For savers, fees can quietly reduce returns. A low-interest savings account combined with periodic charges may result in minimal or even negative real growth after inflation. This is why understanding fee structures is just as important as understanding interest rates. Recognizing fees as part of how banks profit does not imply wrongdoing. It highlights the importance of awareness. When individuals understand how fees work, they gain control over their banking choices. Stability. Why banks depend on savers? Beyond interest and fees, savings accounts provide banks with something even more valuable: stability. In the financial world, stability is essential. It allows banks to plan, lend responsibly, and operate confidently over long periods of time. Most savers do not withdraw all their money at once. Deposits tend to remain in accounts for months or even years. This predictable behavior allows banks to estimate how much money will stay available on a daily basis. With this information, they can issue loans, manage cash flow, and meet regulatory requirements without excessive risk. Stable deposits reduce reliance on volatile funding sources such as short-term borrowing or market-based financing. Those sources can become expensive or unreliable during economic uncertainty. Savings accounts, by contrast, offer consistency. This is why banks focus heavily on attracting and retaining depositors, even when interest rates are low. Stability also supports long-term planning. Banks use deposit trends to decide where to expand, which products to offer, and how much capital to allocate to different types of loans. Without steady savings inflows, these decisions would become far more uncertain. For savers, this stability explains why savings accounts emphasize accessibility and security. The bank's ability to function smoothly depends on customer trust. When people feel confident that their money is safe and available, the system remains balanced. The illusion of growth in savings accounts. At first glance, savings accounts appear to offer steady progress. Balances slowly increase, interest accumulates, and monthly statements show small gains. This creates the feeling that money is growing safely over time. However, this sense of progress can be misleading. The interest earned on savings accounts is often lower than the rate at which everyday costs increase. Inflation quietly reduces purchasing power even when account balances rise. While the number in the account goes up, what that money can actually buy may decline. This difference is subtle, which is why many people do not notice it immediately. Banks are aware of this psychological effect. Showing consistent but modest growth helps maintain customer satisfaction. As long as savers feel their money is doing something, they are less likely to move funds elsewhere. Stability benefits the system, and perception plays a major role in maintaining that stability. Another factor is time. Savings accounts are designed for short-term holding, not long-term wealth building. When money stays parked for years, the opportunity cost becomes significant. Funds that could support long-term growth remain in low-yield environments instead. This does not mean savings accounts are ineffective. They serve a clear purpose: liquidity, safety, and peace of mind. Problems arise only when expectations do not match reality. Treating savings as a growth tool can lead to frustration and slow progress toward financial goals. Why most people rely on savings alone. For many Americans, savings accounts feel like the safest and simplest option. From a young age, people are taught that saving money is responsible behavior. This message is repeated by families, schools, and even banks themselves. Over time, savings become the default choice for storing money. Simplicity plays a major role. Savings accounts are easy to open, easy to understand, and require little ongoing attention. There are no complex rules, daily decisions, or market movements to follow. This convenience makes savings especially attractive to people who want stability over uncertainty. Fear also influences behavior. Economic downturns, market crashes, and financial crises leave lasting impressions. When people experience or witness financial loss, they often prioritize protection over growth. Savings accounts offer emotional comfort, even if returns are limited. Banks benefit from this mindset. When customers remain focused solely on savings, deposits stay predictable and long-term. This reliability strengthens the banking system and supports lending activities. The system continues smoothly when large numbers of people behave in similar cautious ways. Another factor is information overload. Financial products can appear complicated and intimidating. Faced with too many choices, many individuals prefer the option that feels familiar. Savings accounts represent certainty in an environment that often feels confusing. This reliance is not necessarily a mistake. Savings accounts fulfill an essential role by providing liquidity and security. The challenge arises when they become the only financial tool people use: awareness, making your money work smarter. Understanding the limitations of savings accounts is the first step towards smarter financial thinking. While deposits provide security, they rarely generate substantial growth. Awareness allows individuals to approach their finances with clarity rather than relying solely on perception. Many people do not realize how opportunity cost affects their savings. Money kept in low-interest accounts grows slowly, and inflation gradually reduces purchasing power. Over time, this gap between perceived and real value becomes significant. Recognizing this helps people see savings as one part of a broader financial picture, rather than the sole tool for wealth building. Awareness also involves understanding the system. Banks use deposits to fund loans, earn interest, and generate fees. By knowing how money moves and works behind the scenes, individuals gain insight into why returns on savings are modest. Knowledge empowers people to make decisions with confidence and reduces frustration when growth is slower than expected. Another aspect is patience. Savings accounts serve as a buffer for emergencies or short-term goals. They are not intended to create rapid wealth. Understanding this distinction encourages individuals to align their financial habits with the appropriate purpose for each tool. Additionally, awareness allows for better planning. Recognizing the difference between security and growth, people can decide when to keep funds liquid and when to explore other avenues for long-term value. This mindset does not require taking unnecessary risks, but emphasizes informed choice and strategy. Conclusion: what your savings really mean. Savings accounts are often seen as the cornerstone of personal finance. They provide security, liquidity, and peace of mind. But as we have explored, their role extends beyond simple storage. Your deposits do more than sit in a vault. They fuel lending, support financial stability, and generate revenue for banks. Understanding this reality is essential for financial awareness. The key takeaway is perspective. Savings accounts are not designed for rapid growth. They are designed for protection and accessibility. While interest accumulates slowly, the true value lies in the safety and predictability they offer. Recognizing this helps manage expectations and reduces frustration over modest returns. Another important point is control. Awareness of how banks operate allows individuals to make informed choices. Knowing the difference between security and growth and understanding fees, interest gaps, and the movement of deposits empowers people to plan their finances strategically. This knowledge transforms passive saving into thoughtful, purposeful action. Savings are also foundational. They provide a buffer for emergencies, short-term goals, or unexpected expenses. Treating them as a stable base rather than a high-yield investment creates a stronger financial structure. Long-term growth is better achieved through diversified strategies, but savings remain the essential starting point. Finally, the journey of understanding money strengthens financial literacy. It reveals how institutions operate, clarifies personal choices, and encourages smarter decisions. Education is the most powerful tool for financial empowerment, far more than fear or speculation. By recognizing the true role of savings accounts, individuals gain clarity, confidence, and control. Your money is safe, your choices are informed, and your financial future becomes more predictable and intentional. Banks grow powerful through understanding money. Individuals gain control by learning the same system. Financial awareness is the first step toward smarter decisions and long-term security.